Very good morning, Thursday 27th of April, get the briefing underway. And I guess we need to have a quick recap of what we saw yesterday in regard to let's focus on US equities, really a two-part story, one of which when US markets started to open yesterday, US equity markets started to move higher. We broke the previous day's highs, all coming amid some comments pretty early doors in North America from Steven Mnuchin, who's the Treasury Secretary of the US. So rather than Trump, it was him who ushered the first kind of words and confirming the corporate tax deal about the reduction that they're aiming to 15%. Pretty light on details, but people were looking to him to provide some of that later on in the evening at 6:30. Well, if you start looking towards the latter part of the session, after initially there was some mild optimism about the fact that, as much as Trump was saying about a phenomenal tax plan, it actually seemed as though maybe possibly the more credible Mnuchin's plans were identical, and so the market kind of liked it to a fairly moderate degree. It wasn't outright aggressive, but then when the details started to emerge, you can see quite a significant pullback in the markets. Actually, off these initial highs, one of the first moves that we saw was a decline in quite an aggressive fashion. You see that one specific red candlestick there of quite a big pullback in an immediate fashion. And actually, before we get into the tax plan issue, that came after circulation of a source comment that was suggesting that the US administration was thinking about breaking up the NAFTA agreement, essentially. So the agreements that's in place between the US, Canada and Mexico. Obviously this has negative read across into likes of pursuing this protectionist angle, particularly with some of these neighboring countries and trade partners, and the market didn't like it. It was kind of Trump going back to where we were a few weeks ago, and so had quite an aggressive sell-off. Then as we got later into the final kind of half an hour of Wall Street, once the details started to come out on the corporate tax plan, this was kind of what we were talking about yesterday afternoon as a potential scenario. What more can they effectively say that you hadn't already heard? I'd say it'd be very hard for them to really call or talk this market up any higher, because we've already known what the tax plan framework is. Highly unlikely they were going to unveil any kind of concrete in-depth measures. In fact, let me just show you the actual tax plan. This is the phenomenal tax plan. One page, has about 20 bullet points, absolutely zero detail really. I trust that the White House is paying their Microsoft Word subscription. I'm sure this took much more than 5 minutes to knock up between the whole administration. But I find this absolutely shocking in terms of how they can get away with this sort of just elementary execution of what is arguably one of the bellwether proposals for an entire administration. And then when you think about it more from a market perspective, we've rallied such a phenomenally long way, to the point of which the Fed have even commented before in their recent FOMC minutes that stock prices are looking a little overvalued. The hopes of the equity market reside in plans like this going through. But such simple kind of, it's almost like a wish list at Christmas when you read this. I'm going to grow the economy and create millions of jobs. I'm going to make America more competitive and pass both chambers. It's like, that's great, Donald. That's absolutely fantastic. I'm sure you mean well and you are ambitious. Your ambition knows no limit. The only problem here is that it's becoming increasingly frustrating listening to Trump, only to be let down by the actual kind of underlying detail. The longer this goes on, I can assure you the market at some point or another will get fed up. And then this whole Trump trade, which has lifted the market aggressively since November, you know, in terms of the equity market and specifically, is in real danger of getting unwound. You know, we looked at those FANG stocks yesterday. People are still at this present point. We saw the NASDAQ composite, of course, breach fresh all-time highs just 2 days ago. Likes of Facebook up nearly 30% year to date. You know, the quicker they rise, the harder they fall, you could say. And I don't want to be a doomsday slayer, but you know, Trump is putting a lot of faith in the fact that the US economy will continue to tick along and will gradually improve, and in order for him to buy some time before he can push through these proposals in more detail. In summary, this document says that throughout the month of May, the Trump administration will hold listening sessions with stakeholders to receive their input and will continue working with the House and the Senate to develop the details of a plan. So, you know, the details on this aren't even done. This is just an overreaching top-level framework of numbers, and then we're going to have to listen throughout the next kind of 4 weeks, I guess, 5 weeks, before we get anywhere near any type of concrete detail, and then probably weeks after that before we get to the point where there's congressional actual hearings about trying to vote this through. So definitely nothing in the immediate future is going to happen on this. On the NAFTA front, though, that story we just talked about, obviously it was an immediate negative in US assets when he talked about, or there was a source comment suggestive that Trump was thinking about breaking the NAFTA agreement. However, Trump himself did come out later that afternoon in the US and ruled out a swift NAFTA withdrawal in favor of renegotiation. So this was actually much more positive situation. He said the US wanted to pursue talks with Mexico and Canada. So a much more conciliatory tone from Trump himself, putting to bed some of those rumors that circulated, and possibly then that's what negated some of the outright sell-off in this move. And actually, in terms of the US finish, it was pretty flat because we had already built up some gains on the earlier Mnuchin comments. So Trump still a pretty punchy force in terms of moving these financial markets. So you definitely still have to keep a close ear on it. But this whole hype about a phenomenal tax plan, again, it looks pretty good on paper from a bullet point structure point of view. The whole issue is when you actually start drilling down to the details and whether he can get that done, and then how long is it going to take. Obviously Obamacare is still ongoing at this point. Some of the assets that moved quite sharply on the back of the president saying he will not immediately terminate NAFTA. Check out the movement in the Mexican peso yesterday. When the initial reports came out, peso got absolutely killed for a short period of time, only to then completely recover to net neutral position. Certainly if you were looking at the peso, any of the live guys in trading live, then certainly that's livening up in volatility as Trump kind of seesaws in some of his communication. Okay, quick look back at the charts then. So equity finish in the US was relatively benign despite some of the seesaw price action. One thing for European equities this morning, we are slightly negative. Not really too much to talk about in terms of the US, or excuse me, Asian indices. We did have the Bank of Japan overnight. So in terms of the headline, the Bank of Japan kept their monetary policy unchanged overnight, but offered its most optimistic assessment of the economy in 9 years, signalling its confidence that a pickup in overseas demand will help sustain an export-driven recovery. But the central bank slightly cut its inflation forecast. So on the balance, quite optimistic tone, but cutting back on the inflation forecast, net fairly neutral, not too much of a read across into how our markets have opened this morning. But going back to the European equities, one thing that we have had, And something we were talking about here yesterday was about a number of European corporate earnings that are starting to come out now. And you've had a couple of big names. So just running through a couple of the percentage movers at the open. Lloyds Banking Group in the FTSE up 5% following earnings. Bayer, one of the bigger German DAX constituents, up over 2%. Deutsche Bank, they had their earnings report this morning. They're down at the open about 4%. Deutsche Lufthansa down 2.4%. And Airbus are down about 1.8% as we got cash markets underway now. So a bit of a mixed bag in terms of the earnings reports overall. Deutsche Bank, I don't think that's a great concern. I think the fact that they're down 4%, I think this is more to do with the fact that their executive board have been pretty bullish about their prospects. They're going through a turnaround at the moment and things aren't going quite as well as planned, or in terms of not quite reaching the timelines that they wanted, and so the market's seen a little bit disappointed despite a pickup in their profitability. Elsewhere in the other currency markets, cables stood out this morning. We've had a little bit of a squeeze on the upside. Obviously we were looking at this fairly tight range that consolidated some of the price action for quite a while. We were eyeing that yesterday around this point, which was just short as well with the R1, but we've managed to get above there in terms of the morning session. And in terms of where we are at the moment, we briefly touched just above 129.29. If I just zoom this out a little bit, this was the move that we had after Theresa May called the snap election. People like that in terms of the ability for Conservatives to secure a much larger outright majority in Parliament, to be more flexible with their approach with Brexit. Consolidated, now we started to break above on the top end of that. At the time of that move, you remember we were talking thereafter about where does cable go from here. Now that we had breached a very key level, that key level was that 128.06, which we had talked about many times before. That was that post-Brexit support, the breach that led to aggressive selling and then resistance thereafter. So having got above there now, that still seems to be a bit of a flaw to the current direction, at least to the pair. And so that 130 target still seems likely at this point. I'd say 130, just from a psychological standpoint, seems to be a fairly significant level. A lot of the banks have been looking at that, and so as such I'd be expecting maybe some stern resistance there as people might exit this initial long, which will come obviously as we get in the weeks ahead. Once the French election passes, then it's game on for the Brexit talks, which have kind of been on the sidelines for the time being. So definitely looking fairly good for a test on that 130. Could potentially come as soon as this week. Okay, elsewhere, let's have a quick look at the euro, because we've seen a bit of a pullback during a partial part of yesterday's session. We initially broke that end of March high, where if I look at it on a weekly, puts us up at the highest levels since really where we were since the decline on the dollar strength on the Trump trade from the US election. So that kind of price band as well that had been ranging. We briefly tested it on the 27th of March, but that breach that we had has been fairly short-lived, and we're kind of residing at around that previous range high of 109.49. I would imagine that's where it will stay at least until 130 when we get the ECB press conference. People trying to ascertain how hawkish the ECB might become, or in fact the opposite, dovish, if they decide to sit on their hands and wait for the French situation to play out. But we'll talk about that just in a few moments' time. Elsewhere, bunds likewise, potentially not too much to come until we hear further from Draghi. On the upside, you've got yesterday's, well, just before the Eurex close, we had an initial peak seen at 125.20. That was also kind of resistance that was seen in the afternoon of 2 days ago as well, so keep an eye on. Okay, so let's have a look at the ECB, and we're going to talk about this much more this afternoon, but I'll give you hopefully a general overview of what we're looking for today. So Draghi has history lesson to tell in ECB stimulus exit debate. Now, if this doesn't make sense, let me show you quickly a chart that some of you might not be aware of if you weren't in the markets probably, well, 4 years ago, 5 years ago now. And this was ECB. These are the three main benchmark ECB interest rates. So the one that you're probably most familiar with is the deposit rate, which is the yellow line, because that's the one that's gone into negative territory, which is currently minus 0.4%. The other rates currently reside at either 0 or just slightly positive. The negative deposit rate, though, is the one that people have talked about that could potentially move higher in a scenario that's different to the Fed, in where Europe might decide to continue doing QE but raise the deposit rate back in towards 0 territory. What is interesting here is obviously on the far left, this is looking at late 2008, 2009. This is when we went into the major part of the global financial crisis, very aggressive cutting of interest rates all the way down to the lower bound of effectively 0. Then what was interesting was at that point, with economic conditions fairly stabilizing after a period of accommodative monetary policy, and then as inflation threat that might pick up on the premise of money supply coming in via ongoing QE around the world, this was actually one of the, you could term, biggest mistakes of the exit from financial crisis, was when Jean-Claude Trichet actually hiked interest rates on the belief that, you know, we should start to return of normalization of policy. Obviously, we're out here in 2017 and we still haven't in Europe returned to anywhere near kind of normalizing policy at this point. Trichet thought in early part of 2011 we should have got this underway. What happened here was really interesting, because in November of 2011, which was pretty much this exact point of when rates then got reversed, could anyone tell me what happened specifically in November of 2011? What was the difference in terms of the ECB structure in November 2011? And that immediately then followed an interest rate cut. Anyone in the chat room can tell me. Okay, I can hear busy fingers typing. Okay, Paddy. Yep. Mario Draghi just appears on the scene. Now, Draghi was at the head of the Italian central bank. He was involved with the ECB for a long time prior to actually taking the helm. Draghi arrived. Many people thought, well, no, he's not really going to go against the governor, or he's only just stepped in. But literally, first meeting, bang, he just reverses an entire policy that his former predecessor had put in place. Very bold move. The markets actually really liked it at the time in terms of they thought it was a good thing. Draghi making a real authoritative stamp, and actually he reversed policy entirely within the next 2 meetings, and even more so thereafter, and all the way to where we are at this present point. So when people say Draghi has history lesson to tell, this is what they're referring to. They're referring to the mistake that most people see that Draghi made, or excuse me, Trichet made, in hiking rates too early. Now, where we're at the moment, and what a lot of the press are talking about in this ECB meeting in particular, is about France. And the fact that Macron and Le Pen have gone into the final runoff has meant that by majority that this French election is all but a done deal, and that Macron will win, and therefore the potential for a disruption in the European economy is negated, and one of the biggest tail risks for Europe in 2017 falls away. What does that mean for the central bank then? It means, well then, in terms of the central bank, If you look at underlying price pressures, for example, core inflation is forecast to approach ECB goal in 2019. But if you look at inflation in general, it has been creeping up in Europe. The only thing is it's started to slow down slightly more recently, and effectively they're not going to hit their goal until 2019 in terms of core inflation. So that's still some way off. The other thing here as well is about exit path. This is a Bloomberg survey economists conducted in the last few days about what they're looking at as a timeline from here going further out. What do we expect the ECB to do on a consensus view? And so they're looking at Q2 2017. So we're looking at June. Most economists see the ECB to change its rate guidance at the June 6th meeting. Change rate guidance would be a communicative change in wording to suggest then something's going to come in the months thereafter. Remember, changing, I'd say, policy direction is kind of like trying to turn the Titanic. It happens very slowly. The actual turn doesn't happen until months thereafter. So it's not until Q3 of 2017 that the ECB are to extend QE into 2018 and flag a reduction of monthly purchases. Q1 of 2018, so we're talking really this time kind of next year, ECB to start gradually phasing out the QE program over 6 months. Then Q3 of 2018, ECB to raise deposit rate from record low minus 0.4%. So in reality, despite the fact that the PMI data, manufacturing and services, if you remember last week, in France, 6-year high, Germany, similar, all these data points would suggest a fairly healthy economic situation in Europe, with inflation slowly picking up, which you would think as well with the Macron win in the first round, meaning that the French election risk has gone away, should lend its hand for the ECB to become more hawkish. However, they're in no rush is the kind of take-home point. This timeline would kind of ratify that. The fact that the core inflation is not going to hit target for a number of years yet would also suggest that there's no need to rush, and particularly Draghi having seen the mistakes of what Trichet made previously in 2011. So key parts to look out for today with the ECB, the opening statement. So of course we have the interest rates first, that's at 12:45. Absolutely no one is expecting anything unusual to happen at 12:45. As such, the reaction in the market will likely be minimal. What people are interested in, of course, is the 1:30 commencement of the press conference. What we're looking out for here, and the big question on everyone's lips, is what do the ECB Council think a win for Macron, how will that change the economic outlook? Now remember what I've said to you guys before, one word out of place in a central bank policy statement can mean the difference from being uber hawkish, just slightly hawkish, neutral, ultra dovish, and so on and so forth. Just a couple of tweaks to a few words can have very big ramifications in terms of market pricing. One of the key words here the FT are looking at is whether Mr. Draghi adjusts the customary phrase in his opening statement about risks tilted to the downside. That's a sentence that's been in place for a long time. Does he now upgrade that, become more optimistic on the situation, mainly down to the Macron effect, and does he declare instead that risks are now balanced? So instead of being tilted with a bias to downside, risks are now balanced. That is a hawkish signal if that does occur. This, as I was just saying, the PMI data obviously has been strong. So what do you think the likes of Germany, Jens Weidmann of the Bundesbank, will want to be doing? He is obviously sitting at the most hawkish end of the ECB spectrum. He would want to be thinking more along the lines of, we need to start thinking at least about this kind of exit strategy sooner rather than later, because inflation is on the up, and with these readings picking up, that's only going to continue to be the case. Eurozone inflation then is very important. Any comments surrounding that issue would be closely monitored in language-wise in the opening statement and also the Q&A to follow. But as you can see, really, headline inflation has shot up as we've seen some volatile movement in crude oil recently, having got back up to this kind of $50 area. However, core inflation, so if you strip out the energy and food components, which are the most volatile, core inflation is really not doing a lot. And it's core inflation that really is probably the more key and what they're looking at as they're timing towards what the underlying inflationary pressure situation is. And again, this isn't going to move to target until going all the way out to 2019. So much longer drawn out. No need then for the ECB to rush, you would think. The other thing is, don't forget, obviously Macron at this point hasn't won just yet. Although the market is very much of the belief that the French situation in terms of the presidency, that he will win, by no means is a completely slam dunk done deal at this point. And so why rush? This meeting comes right in the middle of that process. It makes absolutely no logical reason for them to, I would say, to make much movement at this particular meeting. My overall assessment, I would say, about this ECB day overall is that I think that we might hear a slightly dovishly sounding, neutral to dovish sounding ECB. I think that they might be a little bit cautious about wanting to make too many noises about optimism, given the fact that the euro currency is now at its highest point since really November last year. The euro trading at 110 gets slightly on the more uncomfortable side in terms of the ECB, and is this an area now where they start to kind of control market expectations, because ultimately any changes from the ECB are not going to happen for a long period of time. And given the French situation is ongoing, I do not see any reason for them to sound too upbeat, because there is still a risk associated with that event. And inflation has yet to really bite in terms of the core inflation reading. So it's kind of my kind of take, if you like, on where we are with the ECB. Obviously, if you do hear a more dovishly sounding press conference, then this is normally being met with a bid tone in terms of European equities. So things like the DAX and the Euro stocks would probably translate into some mild strength if that was the situation. Then you'd be looking at the euro to just pare back. Looking at the slightly longer term ranges here, obviously we had the big gap up. So on the downside, 109 would probably be a logical pullback point, given the resistance that was seen in the day after the elections on Monday. Then we've had it provide some support thereafter in the futures. Obviously, if it is much more dovish, then on the downside, you'd be looking at the 108.48.5. Any break on there, then a gap fill to 108 and those previous highs we were trading at. But it would need to be pretty dovish in that sense to get down to there on the intraday, I'd say. But that was what I'd be looking for in that scenario. Okay, one other thing, just before we get onto the calendar, I did see this tweet from last night. This is the latest YouGov poll looking at the UK election, obviously coming up in early part of June, and the Conservative lead has shrunk to 16%. And so -3, Labour have actually captured +4. UKIP back in as well with +2. So a little bit of movement here. The one that actually I find probably most surprising is the Lib Dems have so far, in opinion polls, completely failed to capture really public sentiment about being a credible and viable alternative vote. The public hasn't bought into it at this point, and the Lib Dems have made very little headway, if any at all, as to what some people were looking at when the initial election was called. Labour maybe just picking up a little bit from their lowest point, but still a very significant margin for the Conservatives. Okay, calendar. We've had a couple of the German regional CPIs already come out since I've been talking. Just to run you through, you've had Brandenburg The month-on-month minus 0.1%, previous 0.3%. Year-on-year 1.8 against previous 1.4. We've just got Hesse coming in 2.1% year-on-year against 1.7 previous. Bavaria 1.9 against 1.7 previous. So on the monthly readings, slightly negative for the German states. In the case of Brandenburg, Bavaria, Hesse flat, but on the year-on-year comparison, slightly higher. I'd say nothing that's caused too much of a read across into asset prices though this morning. Elsewhere, going through the session, these Eurozone economic sentiment and climate data, I know there's a cluster of numbers coming out at 10. These are really unimportant. I think in all my years I've probably never seen these data points move the market, so I wouldn't be expecting too much from that. And also given the fact that I would say most intraday traders or speculative traders are going to be sitting on their hands, the market will want to just wait and see what it is that we get from the ECB. And again, it's not the 12:45, it's the 1:30 press conference that's going to be very important. You do also have durable goods orders coming out at 1:30 with the regular US jobs data, but in all honesty, the market will overlook that and will focus on Draghi, I would imagine. So, final word then, you might want to be a little bit more conservative this morning, because likelihood is the best will come later when the press conference gets underway. There's a risk, I would say, of really strategy building, of looking at it two ways. Either the ECB becomes moderately more hawkish, they address downside risks tilted to the downside, being more balanced going forward. The Macron win alleviates any political uncertainty, so therefore means they can become more optimistic. That's your more bullish scenario, or hawkish. The opposite, negative, being they pay note that these things have occurred, however they're in no rush until they see further concrete evidence of core inflation picking up, wage growth improving, and so on and so forth. And actually it's very much a copy paste repeat type holding pattern for the ECB, which the market will likely interpret as being slightly more on the dovish side. Okay guys, that's it. So I'll see you in the chat room, and have a good day ahead. Thank you.